Welcome to today's Explainer. Let's dive right into this massive June 6th market shockwave. The drama unfolding in the crypto markets right now honestly feels exactly like a visceral, high-stakes anime battle, complete with those vibrant comet colors flashing red across the trading boards. We are going to treat this market battlefield like a tactical analysis of a perfect storm. We'll break down exactly what caused major assets to plunge to multi-year lows and what the structural data says about where we go next. Let's get into it. The market was hit with a devastating blow right out of the gate. We're talking about up to $1.8 billion, yes, billion with a B, in long positions being completely liquidated in just a 24-hour window. This immense cascade of forced selling drove the fear and greed index down to an extreme low. We're looking at a reading of 11, and get this, some trackers plummeted all the way down to a 4. When you see numbers like that, you know for sure we've entered a capitulation phase, where forced selling just completely overrides any underlying fundamentals. To really capture the raw emotion on the front lines of this crash, check out what Binance Square trader Zongzi posted. They perfectly summarized the pain of retail traders watching Bitcoin slice right through that critical 60K support level. They wrote, "If your spot positions are set, just check them less often. Otherwise, even plain water will taste more bitter than coffee." It's a slightly humorous but deeply accurate reflection of the psychological toll on traders right now. When the 60,000 level gave way, it literally felt like a heavy armor shield shattering. Section 1. The June 6 Bloodbath and Altcoin Distress. Looking across the wider battlefield, the carnage absolutely wasn't just limited to Bitcoin. Actually, for a lot of the altcoins, the structural damage was significantly worse. Ethereum took a brutal hit, plummeting down to the 1500 level. Crucially, it lost its 200-day moving average and faced over $500 million in leveraged long liquidations itself. That is a massive technical breakdown. Meanwhile, XRP crashed down to $1.07. This was driven by a heavy combo of whale distribution and ongoing uncertainty regarding the Celerity Act. The defensive lines across the top crypto assets were simply collapsing. And adding even more fuel to the panic, we had specific protocol emergencies. Zcash suffered a massive structural hit following the disclosure of a critical vulnerability known as the orchard bug. Now, this wasn't just a market fluctuation. This bug theoretically allowed for unlimited counterfeit coin creation. As you can imagine, that triggered a massive 37 to 50% crash for the token. They did manage a slight relief bounce after an emergency hard fork, but, the psychological damage to the market's trust was already done. Section 2, the liquidity crunch, macro forces. Pulling the camera back to our tactical command center, we see this intraday carnage is actually being driven by overpowering, unseen macroeconomic forces. This isn't just about crypto. It's about the oxygen in the global financial room. Take a look at the data map in global net liquidity. It illustrates how major central bank balance sheets have completely stalled out. Since crypto relies way more heavily on expanding liquidity than traditional assets that have earnings or dividends, this stagnant liquidity acts as a massive structural constraint on any potential rally. The fuel line is totally pinched. Diving deeper into Benjamin Cowen's research, his liquidity risk model confirms exactly what we are feeling. We're in a highly restrictive liquidity environment right now. Historically, when this risk metric enters these elevated levels, it actively suppresses upside potential and makes risk assets incredibly fragile. Even if liquidity isn't tightening at a breakneck pace, the simple lack of incremental new liquidity is enough to choke out a speculative market. And Horizon doesn't exactly show immediate relief. Traders have largely abandoned any hopes for Federal Reserve rate cuts in 2026, pricing in a massive 95 to 98% probability of no change. This aligns directly with new Fed Chair Kevin Warsh's firm policy stance on managing inflation. Warsh's hawkish approach continues to push yield higher, which systematically rotates capital away from risk assets like crypto and back into safer, yield-bearing traditional assets. Section 3. Flight to quality. Capital consolidates. Faced with this overwhelming macro pressure, capital isn't trying to fight the trend. It's actively retreating to defensive strongholds. We can see this retreat clearly by looking at market breadth, a diagnostic reading showing capital rotation. Right now, it shows extreme deterioration. Out of 390 tracked tokens, only 27 are showing positive movement. Think about that. That means virtually no capital is rotating out on the risk curve into altcoins. Everyone is running for cover. Now, what's really interesting here is how this flight to safety is visually proven through dominance metrics. On one side, Bitcoin dominance is actually trending higher when you exclude stablecoins. On the other, stablecoin dominance itself is surging violently upward. So what does this tell us?
It means investors aren't buying altcoins. They're either hiding in the relative quality of Bitcoin or they're cashing out into stablecoins entirely, just parking their capital on the sidelines.
Section 4. The institutional shift. Strategic exodus.
While the retail panic is totally visceral, institutional players are executing a much more calculated tactical retreat. Spot Bitcoin ETFs, which were the massive engine of demand earlier, just hit a brutal 13-day outflow streak. We're talking about $4.4 billion leaving the ecosystem, signaling that flow-driven institutional demand has turned decisively negative. And adding a bit of a psychological hit, MicroStrategy made a strategic sale of 32 Bitcoin for about $2.5 million. Now, sure, that's a drop in the bucket for them, but it marks their first actual sale in 4 years. Traders definitely noticed.
However, before we declare total institutional abandonment, check out the broader data. While the flow-driven demand from ETFs has reversed, structural accumulation from public companies remains largely intact and is actually continuing to build. Corporate treasuries are clearly playing a longer game here, creating a solid baseline of support beneath the chaos. Institutional demand hasn't vanished. It's just shifted from a catalyst for explosive upside to a foundation for long-term stability.
Section 5. Time-based capitulation, unwinding excess. So the crucial point we need to figure out is whether this intense battle is finally over or if we're just entering a prolonged siege. Looking at Benjamin Cowan's comparison to the 2019 quantitative tightening cycle, we see a totally fascinating parallel. This roughly 50% drawdown from the cycle top is actually right in line with the initial phases of historical liquidity-driven declines. Back in 2019, this exact type of drop led to a long, drawn-out period of sideways, choppy consolidation rather than an immediate V-shaped recovery.
And on-chain metrics absolutely back this up. The MVRV Z-score shows that while the cycle's extreme excess valuation has definitely been unwound, we're out of the danger zone at the top, we haven't quite reached the deep distress levels that historically signal a true durable generational bottom. We are firmly stuck in the middle ground right now. Coupled with a massive, persistent drop in social participation and retail engagement, the data points to a very specific phenomenon. We are likely suffering a time-based capitulation. What does that mean? Well, it means the market isn't going to end in a single fiery climax of price destruction. Instead, it's going to slowly grind out the weak hands over time, exhausting traders with a prolonged siege of sideways action.
Section 6, the long-term silver lining, a regulatory reset. But hey, amidst the ruins of this crash, a blueprint for rebuilding the infrastructure is quietly being drafted at the highest levels. A major shift is happening in Washington. The SEC just published a draft strategic plan for 2026 to 2030 under new chair Paul Atkins. Rather than the old regulation by enforcement approach, this draft impartially prioritizes establishing a much-needed clear regulatory foundation for the entire digital asset industry over the next 4 years.
And honestly, the language they are using is incredibly striking. The official SEC draft acknowledges that digital assets have the potential to, quote, revolutionize America's financial infrastructure. By officially recognizing this potential, this policy shift strongly suggests our current brutal market reset might simply be the painful process of clearing the path. It's washing out the speculative excess to make way for a much more stable, institutionally supported future. Like a smooth vector animation, everything is slowly snapping into long-term alignment.
So we've mapped out the massive liquidations, the crushing macro liquidity squeeze, and the quiet institutional groundwork being laid for the future. With all this data on the table, we leave you with one vital question to ponder. Is this visceral June 6 bloodbath a final bloody capitulation that clears the board, or simply the opening act of a long, bitter, time-based winter? Let us know how you're positioning yourself and keep your shields up out there. Thanks for joining this explainer.